So every year we do our pulse survey with JP Morgan, looking at where investors are sort of seeing the opportunities in the year ahead in fixed income. And the notable difference that we saw was demand for high yield and emerging market debt. That's a clear comparison, clear area of difference between 2025 and 2026. What do you think is behind that sort of shift in demand from investors?
I think there's been a realization from the market that actually things look okay. And you could argue that there's also a bit of positivity coming through. And if I just think back to where we were earlier this year, we were discussing tariffs. We were very concerned around inflation being high, particularly around about this point of the year. There was a lot of people actually saying the US was going to go into recession on the back of some of these policies. And where we are today is we've almost done about a 180-degree turn. The economy seems to be very resilient. We're seeing corporate profitability continue to look good. We've just come through Q3 earnings, and some of those kind of tariff concerns, they haven't really shone through. And actually, corporations look as if whatever you seem to throw at them in the US, they seem to be able to deal with it. And then at the same time, inflation hasn't accelerated upwards to the same extent. Yes, we're a little bit higher than people or we were earlier in the year, but we're not getting to those 4 or 5% levels that was a concern. And we are having easy policy coming out of the Federal Reserve, and then we've got this fiscal support. So if you can continue to build a picture where the global economy continues to move forward, actually what you want to be looking at is parts of the fixed income market that have got upside and do well as you see growth. And that is parts like the high yield market, parts like the emerging markets. High yield benefits from the all-in yield levels that you can get, 7% or so in the US. Default rates, still below long-run averages, and the carry there is really, really powerful. And then from an emerging market standpoint, I actually feel that investors have been under-allocated to emerging markets for a long time. They haven't really wanted to look at emerging markets, haven't really wanted to talk about the emerging markets, and that is changing as well. So again, an environment of lower policy rates in the US, fiscal support globally, economies continuing to move forward, and an investor that's under-allocated, again, should see a big support for emerging markets. So I think that's why you're seeing these increases in your survey, and we would agree with that within JP Morgan Asset Management.
Do you think there's also potentially a consideration or conversation to be had with investors maybe not being as confident going into these areas of the market themselves, and this maybe bears a conversation about how they're implementing these fixed income allocations? In fact, in the survey results this year, we saw quite a noticeable increase of those preferring an active to a passive implementation approach, actually up 12 percentage points on the year. Can you explain maybe why would an investor be particularly in favor of an active implementation approach on the fixed income side, especially versus equities?
Yeah, I think fixed income as a marketplace really lends itself to active management. So if you think about what fixed income indices are, they're basically rules-based collections of outstanding debt, which means that the larger or the more debt outstanding you have as a company or as a country, you become larger weightings in indices. So that's if you're a passive manager, you ultimately are owning those larger weights. And that may or may not be the right thing to be doing. And from an active management standpoint, you want to have the ability to make those decisions. And also, when you think about just the magnitude of the fixed income markets. So if you look at the global aggregate, the Bloomberg Global Aggregate Index today, over 30,000 line items in there. I mean, it basically calls for active management if you've got a strong, kind of well-researched, experienced team to look at those markets, find those opportunities. And I think just to the point on something like emerging markets, it's a really good example, because if you look at the whole of the emerging market indices, you're seeing massive differences between the opportunities. If you look at somewhere like Brazil today, you can get an all-in yield of around 14% on their local bonds. You look at somewhere like China, you're getting an all-in yield of 1.8% on their 10-year bonds. So there's big differences, but that, for us, creates a big opportunity on the active side to make investment decisions and hopefully generate alpha for our clients.